You're getting ready to buy your first home. You've saved up to about $30,000 and now you're ready to put down 10% on a $300,000 home. You've run the numbers, started picturing furniture in the living room, and then your lender gives you a monthly payment that's a couple $100 more than you expected. That extra cost? Probably PMI. And for a lot of buyers, nobody ever really explained it. So today, let's fix that.
It's the Mortgage 101 podcast where real talk meets home and life.
Hey folks, welcome to Manley's Mortgage Minutes. I'm Manley Haines, and every week we cut through the noise and simplify the mortgage process so you can move forward with clarity and confidence. Today we're talking about PMI, what it is, why it exists, and what it actually costs. And most importantly, how you stop paying for it. Because here's the good news. PMI is not forever. By the end of this, you'll know if you're paying it, how long you'll be likely to have it, and the smartest way to remove it sooner. So let's start with the simple one. PMI stands for Private Mortgage Insurance. And despite that name, it's not insurance for you. It protects the lender in case the borrower defaults on the loan. On a conventional loan, PMI mortgage typically comes into play anytime you put less than 20% down. Now, before you think that doesn't sound fair, let me give you some perspective. This isn't punishment, it's simply how the mortgage system manages risks. If you're putting less money down, the lender is taking more risk because there's less equity in the home at the start. PMI helps offset that risk. In exchange, buyers can purchase a home sooner instead of waiting years to save up 20%. And for many buyers, that trade-off makes sense. Now let's make it real. Say you're buying a $350,000 home somewhere in Metro Milwaukee, maybe Muskego, New Berlin, or right here in Waukesha County. You put 10% down or $35,000. That leaves you with a loan amount of $315,000. PMI on a conventional loan is dependent on things like credit score, down payment, and debt-to-income ratio. For this example, we're going to use a 740 credit score with a debt-to-income ratio of 40%. That works out to about $756 per year, or roughly $63 a month added to your payment. Yeah, that's real money, but it also helps you keep $35,000 in your pocket. So, if you're buying a home, this is something you want to plan for and not be surprised by. Now, here's where a lot of people get tripped up. They think PMI lasts forever, and it doesn't. In fact, there are 3 ways to get rid of it. Number 1, automatic cancellation. The federal law requires lenders to automatically remove PMI once your loan balance reaches 78% of the original home purchase price, assuming you're current on all your payments. That happens naturally over time as you pay down your mortgage. You don't even have to request it. But depending on your loan structure, the timeline could be several years. For many buyers, it might take somewhere in that 8 to 11 year range if they simply let the mortgage run its course. All right, number 2, request cancellation at 80% loan to value. This is where paying attention matters. You don't have to wait for the automatic removal. Once you hit that 80% loan to value, meaning you've built up 20% equity based on the original purchase price, you can contact your lender and request PMI cancellation. You'll generally need a solid payment history, and sometimes the lender may ask for an appraisal. But this is one of those moments where being proactive can save real money. Don't assume that the lender is going to call and remind you. Keep an eye on it. All right, number 3, appreciation-based removal. This is the one that matters in most markets like ours. If your home is appreciated in value, which many homes in Waukesha County and across southeastern Wisconsin have over the last several years, you may have reached 20% equity much sooner than expected. In that case, you may be able to request an appraisal, document the updated value, and ask your lender to remove the PMI early. That can potentially shave years off the timeline. And honestly, this is the one that many homeowners overlook. If you've bought in the last few years and you haven't looked at what your home may be worth today, it's worth a quick conversation. So here's the bottom line. PMI is not a forever payment. It's a temporary cost that gives buyers an opportunity to get into homeownership sooner without waiting years to save for the full 20% down payment. The important part is you understanding the exit strategy. Know your loan balance, pay attention to your home value, and when it gets close to that 20% equity, be proactive. The people who pay PMI longer than they need to usually aren't doing anything wrong. They just didn't know they had options. Now you do. Thanks for joining me on this week's Manley's Mortgage Minutes. And if you're wondering whether you're close to removing your PMI or you just want help understanding where you stand, reach out. We can run some numbers together and build a game plan. And don't forget to check out the Mortgage 101 podcast, where Anthony and I break down what's really happening in the housing and mortgage market each week in a way that actually makes sense. I'm Manley Haines, and thanks for spending a few minutes with me. I'll see you next week.